Okay, welcome. We're going to be reviewing a trade in Foot Locker that I took this past week. I was in it for less than a day, bought it close on Thursday, sold pre-market on Friday. I normally never do fundamental-based trades, but this time I did, and we're going to discuss that. So going into earnings, you can see Foot Locker is down more than 50% for the year. So they massive sell-off. We are charting logarithmically here. I have the playback on, so you cannot see the results of earnings at the moment. But I wanted to show you the chart first before we, go into why I got into this trade. Now, quick note: I never have ever gotten into a stock the day before earnings. I never play earnings personally. I can only say there's only a few trades I've ever sat through on earnings before. Why? Just because there's not much of an edge going into earnings, if you ask me, and others would disagree, and I would say, well, you're a lot more experienced with earnings plays than I am. However, I felt pretty comfortable here. I thought the risk reward was pretty large here, and we're going to discuss why I thought that and what my thoughts were going into this. A little disclaimer though, from a fundamental perspective, I have very little experience. However, I thought my execution on this one and my thesis on this one was respectable, and I thought that it made sense. So they had a dirt low valuation. I don't use the PE ratio. I do, however, look at the EV over EBITDA. Their ratio is only 2.8x, 2.8 times, and generally mid caps are around 10 times, and I would consider a mid cap trading around 5 times to be extremely cheap. I've actually never seen a mid cap this low before, which is kind of interesting. And then final note is that generally companies with valuations at 2.8 times have lots of debt and bad cash flow. So from a financial perspective, they're doing good as well. You can see that their total current assets are easily covered. They can easily cover their liabilities from their total current assets, so they're good on that front. Their cash flow versus spending is also very good. You can see here the cash flow from operating activities easily covers their CapEx and their dividends, so they're free cash flow positive. We know they have positive earnings, and their valuation is dirt cheap. So we know that generally companies shouldn't be trading all the way down here. So what was the sentiment like going into ER? The main reasons why I got into this trade was because their valuation was dirt low. They had good cash flow. So I knew, hey, they're super beaten down this year, probably beaten down more than what's justified. So what was the sentiment going into ER? We know the sentiment was absolutely bearish. Just like retailers have been been beaten down all year, essentially pricing in death because Amazon, everybody's ordering online and everything. And my take on it is kind of that people are still going to go to the malls. They're still going to try things on in person. I know that I personally have only ever bought one pair of shoes offline. I normally go in person and buy shoes. So I know, the sentiment's kind of overdone in my opinion. We also knew that the hurricanes, this quarter, people were expecting massive losses due to the hurricanes, which adds to the negative sentiments. The big one for me was we knew the guidance from Q2 was already really horrible. This is a statement from the CEO from Q2, and he's saying that they think sales are going to be down 3 to 4% over the remainder of the year. So people are already pricing in decreased sales, and most likely, by the chart, we can see that they're probably pricing in sales that are down more than the guidance that he has given here. At least I would say so. We can also see all these revisions. This is just in the last 4 weeks. Everybody's revising estimates down, so we know people are again preaching this bearish sentiment. We know sentiment's absolutely negative here. So this was the chart going into ER. You can actually see the result of ER on this chart. But what I wanted to show you is that we're at the 200 SMA. We are looking at the monthly chart here. We're on the 200 SMA, and we know that that tends to act as support for us. You can see the last time we touched it was right here, and we pop afterwards. And we just know that oftentimes, the 200 SMA can act as dynamic support. This is the 200 EMA, the other line you see. So quick recap. What was I thinking going into this trade? I was thinking, hey, the sentiment's super bearish. Probably more bearish than it should be. So I was thinking, hey, even if we meet expectations, we're probably going to see a nice 10 to 15% pop. Even if we miss expectations, we're probably not going to see more than 3% downside. Maybe I'm wrong. Maybe my thinking's flawed here. It worked, and so hopefully, I'm not reinforcing a negative or poor thinking. But again, my thoughts were, I know the sentiment is already really bearish. So if we get anything that's remotely positive, or even if we come in line with expectations, we're going to see a nice 10 to 15% pop. That's what I was expecting. It was a risk reward thing for me. I'm like, hey, even if we miss a little bit, people are already pricing in that miss most likely. So, I'm betting on a slight beat. So we still need to exercise caution going into Q3. From Q2, this is a statement that came out. This is you read this and then read this. Essentially, an analyst was saying before even Q2 came out, after Q2 came out, they had a massive drop. But he was saying even before Q2 came out that they were extremely, extremely cheap. And he says that they think that they're worth 51, which is higher than their current price during Q2, and that scenario assumed flat store sales and flat store growth or whatnot over the next 10 years. Look at that, 10 years. And so he was saying they're super oversold even before Q2. So now we're in Q3. They're down even more than they were in Q2. So I'm thinking, hey man, they really are dirt cheap. However, we do still need to exercise caution going into this. And I always tell young traders, you don't have an edge going into earnings. So I don't trade them normally, but this time I felt comfortable taking the trade. And I hope you understand why. Again, it's the valuation and the sentiments, and they're financially healthy. So the results of earnings, they had a slight earnings beat. They brought in 87 cents versus 80 expected, so slight beats. The reaction, because they went up 26 to 28% the next day, that reaction just shows how poor that sentiment was going into earnings. Notice this point right here. 2017 net income after Q3 is at $333 million versus the same point last year in 2016 was at $475 million. I think that's just interesting. They're clearly losing. They're clearly getting a lot less money this year than they were last year. Yet we had a massive rally. Expenses rose. That's bearish. Sales are down. That's bearish. Hurricanes cost them $7 million. That's bearish. And I would say this point right here is kind of neutral, but the reaction just shows you how negative that sentiment was. And if we had anything that was, if we had anything that was remotely positive, we were going to see a massive rally, and I figured our downside was limited. So a little disclaimer, again, I don't have much experience with fundamental plays. Normally I would never play anything before earnings. This is the very first time I did, and I felt comfortable doing it from a risk-reward standpoint. The sentiment was the big value driver for me here. Well, the sentiment was the big driver for me here, as well as the valuation. I knew that if we even had something remotely in line with expectations, we were going to see a rally. Why? Because people were expecting worse than estimations, in my opinion. I could have been wrong. And if I was wrong, I figured we'd only see 3 to 5% downside, if that. So, again, the risk reward was good to me here, if you ask me. But the big thing for me, again, was the negative sentiment already priced in due to Q2 results and the existing guidance. So I hope you guys enjoyed this. Maybe you learned something, maybe not. But nonetheless, thanks for tuning in, and subscribe for more.